The slide that I've got called Stocks, Bonds, Bills, and Inflation is a bit of a complex chart, but the top line on that shows the growth of small companies. The next line down shows the growth of all the large companies, S&P 500 for instance. And the next lines down show bonds and treasury bills and then inflation. So if you look at the volatility of those top two lines, the small cap stocks and the large cap stocks, it's quite volatile. The returns go up and down a huge amount. Over that 80-plus year period, it's tough to see the very small time frames where there was monster volatility, but you get a sense of it with the market volatility today as well as looking at that line. The risk that investors suffer is that they buy in today and expect the market to go up tomorrow, and if it doesn't, then they sell out for fear that it will continue to go down. But that chart convinces us that all you have to do is buy and hold that marketplace, and you're going to get the returns of the marketplace, which have been real close to 10% over your lifetime. It's a very simple formula, actually. In fact, the next slide that I have is going to show you that over various time frames, stocks outperform bonds with a percentage of confidence. So the first bar says that
for a 1 year period.
For a 1 year period starting in 1928, each year from 28 through 2008, you had a 68% of the time stocks outperformed bonds. So you had a 68% confidence that stocks were going to outperform bonds. If you do rolling 3 year periods, start with the first 3 years and then drop the first year and add the newest year, then that confidence factor goes up to 76%. Notice that percentage goes up every time frame that's recorded, such that by the time you get to the 20-year period, every 20-year period, rolling 20-year period from 1928 until 2008, stocks outperformed bonds. So would you rather have your money in the bank earning less? Well, that's a question the investor needs to answer.
Yeah.
So if the investor is unwilling to not look at the marketplace and is scared of the volatility, then they're going to have to forego that risk premium, the volatility that occurs in the marketplace, and buy treasuries.
Right.
And they will earn less every 20 years than if they'd put it into the stock market.
Yeah. And some people emotionally can't handle that, and so
That's why they do that.
So they have to accept. Then, like if they say, well, I'm just going to keep it in the bank, okay, then you're going to get the bank's returns, which right now is about, if you got a really good one, maybe about 1%. It's really exciting returns. So, but that the principal is going to be there. At least it's insured by the U.S. government. So, if the U.S. government holds up, then your principal will be safe. All right. So I guess what we've said is, if you are going to get a higher return, if you desire the higher returns of the marketplace, then you're just going to have to endure, and it's likely that you should invest in the marketplace, or you're just not going to be able to, for example, keep up with inflation and so forth and fund like a retirement, fund education.
For anyone planning for retirement, they need to put the money into the stock market. You need to depend on the stock market to give you enough earning potential so that you can get ahead of inflation after taxes and expenses.
And the other thing, so there are other investments. And we talked about that in other shows.
Yes.
So there are alternative investments. So you need to be an investor, I guess, is what we're saying. And the stock market has particular advantages. For example, liquidity. You can sell your stock tomorrow. You can't do that just with a piece of real estate. So there's advantages of the stock market compared to other things that really we probably don't have time to go into right now. But as far as investing in turbulent times, probably this is an area that at least a part of your portfolio should be in.
Yes.
Okay.
So
Now,
one of the things that we say is that you don't have to have all your money in the stock market. You can use alternatives, and that will reduce the volatility of your portfolio.
right.
So look on Mike's site, and you can see a previous interview that we did
Okay.
and talked about alternatives.
So it's in financialinsiderweekly.com, and we have our past shows all posted there. Okay, we have to move on here because time is going.
Okay.
What is the role of the time horizon in the investment process? So we talked a little bit about that, but we've got a slide about it here.
Yeah, the slide says beating the market. So when you invest in a mutual fund, what you're doing is you're giving some unknown manager or someone by name your money, and their spoken or unspoken promise is that they're going to be able to research the past in an effort to know when to buy the right stocks such that they will get good returns in the mutual fund. Okay, so another way to say all of that is that they're going to study the past in an effort to know the future. And the question is, do they accomplish that? Well, the slide that I have called Beating the Market says that for the 5 years ending 2008, Standard & Poor researched all the mutual fund managers and determined that 69% of the managers trading stocks from the list of 500 stocks in the S&P 500 index were unable to outperform just a simple buy and hold index. You didn't have to pay a money manager to pick stocks and time the trade 68% of the time. You could have just bought the index, okay? If you're trading small cap stocks, 78% of the managers were unable to outperform S&P's small cap index. Same is true with the international managers. 87% of the international managers, mutual fund managers, were unable to outperform Standard & Poor's international index.
Isn't that amazing?
So the risk that an investor takes is that they are ultimately underperforming the marketplace by not buying an index. They are trusting either their broker or their 401k manager to give them a mutual fund manager which will outperform. And over about a 10 to 15 year time frame, 99% of the managers do not outperform a simple buy and hold of the index of the marketplace.
So, and I guess part of what we should observe is that they may outperform like 1 year or maybe 2 years, but for somebody to do it even 3 years, it's almost impossible.
A manager, yeah, if you look at the 10-year track record and he's outperformed the index, you look at each year's numbers, and he underperformed for 9 years, and suddenly in 1 year he shot up. Well, we didn't know he was going to beat the market in the 10th year for that 10-year average, and it was just sheer luck that he did anyway. So choosing that winner, that money manager that's going to win today, I don't know how to do that, and I don't know anybody else that in this business that knows how to do that.
Okay. Well, we need to move along. Now, so a lot of people think you just got to get the timing down, right? How do you time the market to maximize gains?
You don't. You can't. There are very few reputable managers who say they can time the market. The slide that I have says, does lightning strike twice? And the concept is that when you time the market, what you're saying is now's the time to be out of the market, sometime later is when to get back in. That's two decisions.
Yes.
And you have to be right both times. If you miss the best trading day, 10 best trading days in a 20-year period, you're going to get half the growth amount than if you just bought and held. So timing's a very, very critical mistake in investments.
Okay. So the next slide that we had is time in versus timing the market.
Yeah, this is a good way to look at the performance of the stock market if you miss 1 day or 5 days or 10 days. So the first chart on the far left says that if you buy and hold the marketplace for 39 years, from 1970 through 2008, that you would earn I'm looking at the rate of return on the bottom row there. You would have earned 9.49% per year. If you missed the one best trading day during that 29-year time frame, your returns would have gone from 9.49 to 9.18%. And your terminal value would have been down $330,000. Look at the difference in numbers. Go all the way out to the end and look at if you missed missed the best 25 days, your return would have gone from 9.5%, your account value was at 3.4 million, down to 5.67%, and your account value was only 860,000. That's a significant loss in earnings. And the chart is just another way to say, don't time the market. Don't even try that.
Okay. Let's look at the next slide, which is called Beating the Market Again. I think this is sort of revisiting.
Yeah. What this shows is that S&P, Standard & Poor, has done this survey for many different time frames, and it doesn't matter which time frame they come up with. During a short 5-year period, 75 to 85% of the managers are unable to outperform a simple buy and hold of the marketplace. What you shouldn't be paying them to manage your money then.
Okay.
They are failing at that task.
And let's look at the last slide in this series, which is the sad story of the average investor.
Yeah. So the average investor in the marketplace, this period ends in 07, and the S&P 500, remember, earned almost 12% per year for the time frame ending in for the 20-year period ending
2007.
in 2007.
Yeah.
Inflation was 3%, and the average investor, instead of earning what the market earned, close to 12, only earned 4.5. That is an indictment of the investing public. The investing public leans on their emotions to help them make investment choices. It's okay to have the emotions. It's just not okay to make the investment decisions using those emotions.
It may be that what you should be doing is the opposite of what your emotions is telling you to do. Okay.
That would be true.
All right.
Yeah.
So let's talk about what is the role of a financial advisor in turbulent
Help clients
times?
through the turbulent times.
Yeah, how do you do it?
Help clients from making mistakes like timing the market.
Yeah.
Help clients from making mistakes like setting up trusts and wills when they have special needs situations. Your previous interview, Mike, was with an attorney who specializes in special needs trusts. So somebody needs to help clients understand the very difficult, problematic financial world that we live in. And a good fee-only financial planner is someone who's set up to do that.
Okay.
The slide that I have in Join Professional Financial Advisors says that you, the client, hire a team of financial planners. In that slide, it's called FWCG because that's the name of our firm. And that, as a team of professional advisors, we're going to help that client understand the information from their other advisors, which includes people like you, the CPA. How about the trustees? How about the lawyers? How about the trust officers? How about the insurance agents? All of those people have what we call silo information, and without someone to help the client interpret, understand, incorporate all of that information into their total plan and their goals, they need to do that by themselves. And the world is just far too complex for that kind of efficient decision making.
Okay. Craig, we're about out of time. I think I'm going to just summarize a little bit and just say, I think that the role of the financial planner, in addition, again, to helping the client with the overall financial planning situation, is sort of to function as a coach, a personal coach, to sort of hold your hand during these turbulent times and say, don't jump. So, folks, we hope that you found this to be helpful and thought-provoking, and we wish you good luck in getting through these turbulent times. And
get a financial planner.
We're going to be going through more of them, okay? And anyway, we'll see you next time on Financial Insider Weekly.